Most people look at a massive, bustling mega mall and see the ultimate passive income machine. They imagine the owner sitting back, casually collecting steady base rents and common area maintenance fees from hundreds of luxury brands month after month. To the untrained eye, it looks like an empire built of concrete and frictionless consumerism. But beneath that polished facade lies a remarkably fragile financial architecture. A mega mall generating $142,500,000 in annual revenue can be completely dismantled in a matter of months, all because of a single 4-line legal clause buried deep inside a tenant lease. Here's the problem. Almost none of what people imagine is actually true. To understand how a $100 million cash machine evaporates into thin air, we have to look at the master architect of this illusion, the developer's spreadsheet. If you're tired of shallow financial advice and want to understand the real game of big money, hit the subscribe button right now to join us in this financial autopsy. Imagine you're a mid-market real estate syndicator. You're a highly pragmatic operator, and you've spent 18 months pitching a vision of stable, inflation-resistant wealth to a close-knit group of private angel investors. Together, you pool your capital, leveraging high net worth relationships to raise exactly $42.50 million, $42,500,000. Your trophy target, a prominent regional shopping mall spanning exactly 850,000 square feet of retail space. On paper, the acquisition looks like a masterclass in value investing. The sticker price is backed by highly reassuring metrics. The property boasts an enviable occupancy rate of 92.41%, indicating a thriving ecosystem of consumer activity. It has a stabilized capitalization rate of 8.5%, and the historical seller's discretionary earnings project a highly predictable, recurring cash flow. This revenue stream is supposed to handily distribute a consistent yield to your investors while leaving your fund with a very healthy asset management spread. Staring at your multi-tabbed Excel spreadsheet late at night, the math feels absolute. You run the financial models over and over, watching the formulas yield perfect green light columns. The structural mechanics of the assets seem completely foolproof. On one side of the ledger, you have the reliable base rent from national fashion outlets, high-end cosmetic boutiques, and established department stores. These are long-term commercial leases with built-in annual rent escalations designed to outpace inflation. On the other side of the ledger, your spreadsheet accounts for common area maintenance fees, universally known as CAM fees. According to your calculations, every single dollar spent on keeping the corridor lights on, sweeping the vast parking lots, running the massive industrial air conditioning units, and securing the perimeter will be clawed back from the tenants on a pro-rata basis. It feels like a beautiful, frictionless ecosystem. The consumer spending fuels the retailers pay the base rents, and their shared operational contributions neutralize the overhead of the physical property. You believe you have acquired a fortress. You believe you have purchased a self-sustaining cash machine that will compound wealth for decades. But in commercial real estate, paper profits are an illusion. The moment the ink dries on the acquisition, the physical assets begin to demand their tribute. The euphoria of the acquisition fades rapidly when the first monthly operating report lands on your desk. In the world of mega assets, physical reality doesn't care about digital spreadsheets. You are about to learn a brutal lesson in fixed cost rigidity. A regional shopping mall is not a passive landholding. It's a highly complex, volatile machine with an insatiable appetite for cash. Every square foot of this 850,000 square foot structure deteriorates in real time, completely indifferent to whether consumers are spending money or staying home. The operating expenses, or OPEX, are relentlessly high and structurally inflexible. You can't just dial them back when market conditions soften. Within your first 90 days of ownership, the mall's centralized HVAC system, a massive industrial-grade chilling plant, suffers a catastrophic structural failure. This is not an ordinary maintenance invoice. It's a major capital expenditure, or CAPEX, that requires immediate funding. Replacing the obsolete chilling unit costs exactly $1,420,500. The capital must be deployed immediately. Why? Because if the indoor climate control fails, your tenants have the legal right to withhold their rent entirely. Simultaneously, the specialized security and loss prevention overhead, which is essential for keeping insurance premiums from spiraling out of control, demands $320,000 every single quarter. These are non-negotiable, non-discretionary expenses.
You cannot run a high-traffic regional hub without secure corridors, and you cannot bargain with depreciating physical infrastructure. This is the exact moment where the comfortable illusion of CAM fees completely shatters. In the theoretical models taught in business schools, CAM fees are viewed as a clean, frictionless pass-through expense. The common belief is that the tenants will pay their pro rata share of all cleaning, security, lighting, and property management costs. However, the operational mathematics of real-world retail assets are far more unforgiving. Because the mall's occupancy rate is not at 100%, there is a vacant gap of 7.59%. The maintenance costs associated with that empty space do not magically disappear. You, the landlord, must cover the pro rata operational share of every vacant square foot out of pocket. This is known as unrecovered CAM. It is a direct, silent cash flow hemorrhage that slowly drains the asset's operating capital. To make matters worse, sophisticated national retail brands possess immense negotiating leverage. Their lease agreements contain strict, legally binding CAM caps that limit how much their operational contributions can rise each year, regardless of inflation. When utility rates spike and the fully loaded labor costs of security teams and maintenance staff rises, you are legally barred from passing those cost overruns to the largest tenants on the property. You are now trapped in a dangerous, counterintuitive feedback loop. In a desperate bid to shore up your dropping occupancy metrics, you try to sign new retail tenants by offering deep rental discounts. But to secure these leases, you must pay out massive upfront tenant improvement allowances and broker commissions. This demands even more immediate CAPEX. You are forced to confront a brutal reality. The harder you struggle to drive up your gross paper revenue, the faster your actual liquid cash reserves are drained. You have fallen directly into the classic liquidity trap, discovering that high-profile asset ownership can easily coexist with absolute financial insolvency. Unrecovered maintenance costs are a slow bleed. But the true fatal blow doesn't come from a leaking roof. It comes from a fundamental mismatch in the financial architecture of the asset itself. To appreciate the sheer scale of this structural trap, you have to dissect the actual physical mechanics of how your acquisition was funded. You did not buy this 850,000 square foot commercial giant with pure cash. You used the ultimate double-edged sword of high finance, extreme leverage. Out of the total purchase price, you secured a commercial mortgage of exactly $30 million. To make the deal appealing to institutional lenders in a highly competitive market, the loan was structured as a 15-year commercial mortgage backed by a floating rate tied directly to the Secured Overnight Financing Rate, or SOFR, plus an additional spread of 325 basis points. When you signed the closing documents, SOFR was coasting at a highly manageable near-zero floor, making your initial interest rate incredibly cheap. The projected monthly debt service was a minor, easily absorbed operational expense on your pro forma statements. It felt like free money. But on the other side of your balance sheet sit your assets, which in this case are your commercial leases. Unlike a bank that can technically adjust its loan yields or short-term lending rates to match market conditions overnight, a retail landlord is bound by the ultimate friction of the real estate sector: long-term lease structures. Your tenants, particularly the mid-tier apparel stores and high-foot traffic cosmetic boutiques, signed lease agreements spanning 10 to 15 years. To entice these brands to lock themselves into your physical space in the first place, you had conceded to highly restrictive lease escalation caps. These clauses dictate that the base rent of these tenants can only increase by a maximum of exactly 2.0% per year, regardless of the consumer price index or macroeconomic inflation. For the next decade, your maximum gross revenue potential from these spaces is mathematically locked in place, frozen in time.
The trap snaps shut when macroeconomic policy shifts. When the Federal Reserve aggressively hikes interest rates to combat inflation, SOFR spikes from near zero to over 5% in a matter of months. Because your commercial mortgage is a floating rate instrument, your interest rate instantly balloons from 3.25% to over 8.25%. Your annual debt service obligation swells, demanding millions of dollars in unplanned, unbudgeted cash outflows. At the exact same time, your real-world revenue remains completely stagnant, handcuffed by the 2.0% lease escalation caps you agreed to during the acquisition. Your interest expenses are climbing at an exponential vertical curve, while your rental income is trapped on a flat horizontal trajectory. The net operating income of the mall is entirely eaten alive by the bank before a single dollar can be allocated to property maintenance or investor distributions. Your net interest spread has not just compressed, it has turned completely negative. This structural misalignment left your mall skating on razor-thin ice. And then the anchor dropped, not to secure the ship, but to drag it directly to the bottom of the ocean. To appreciate the raw mechanical brutality of systemic real estate failure, you have to look at how these financial vulnerabilities scale up. When you operate a single retail storefront, your risk is capped. If your business fails, you break your lease, lose your security deposit, and walk away. But when you aggregate hundreds of these individual leases into an 850,000 square foot regional shopping mall, you are no longer running a simple collection of shops. You are operating an interconnected ecosystem of highly volatile liabilities, where the failure of one giant can trigger a systemic chain reaction. A co-tenancy clause is a heavily negotiated lease provision demanded by smaller retail inline tenants such as boutique clothing stores, jewelers, and specialty cafes. These smaller retailers understand that their economic survival depends entirely on the high foot traffic generated by the massive department stores anchoring the ends of the mall, known as anchor tenants. Under the terms of a standard co-tenancy clause, if a major anchor tenant shuts its doors, or if the overall occupancy rate of the mall falls below a critical threshold, typically set at 70 or 75%, the smaller inline tenants are legally granted the immediate right to either slash their monthly rent payments by exactly 50% or terminate their leases entirely without penalty. For a mall operator, this is the financial equivalent of a landmine. To understand how this mechanism operates on a multi-billion-dollar scale, we must examine the high-profile bankruptcy of CBL Properties in November of 2020. CBL was an incredibly massive real estate investment trust that owned and managed a sprawling portfolio of over 100 regional malls and open-air shopping centers across the United States. For decades, their business model generated highly predictable cash flows. However, as the retail landscape shifted, several of their largest national anchor tenants, including Sears and Bon-Ton, experienced severe operational distress and closed dozens of their underperforming department stores. These closures did not just result in a direct loss of anchor rent for CBL. They acted as a systemic trigger event. Because hundreds of CBL's smaller inline retail leases were structurally bound by co-tenancy clauses, the departure of the anchor tenants immediately authorized these smaller stores to demand drastic rent reductions of up to 50% or to exit the properties altogether without penalty. The cash flow of the entire trust did not decline on a gradual linear path. Instead, it experienced a violent exponential collapse. The massive debt service obligations on CBL's highly leveraged properties remained entirely fixed, while their rental income streams dissolved. The trust could no longer service its debt, leading to a massive Chapter 11 bankruptcy filing, wiped out equity shareholders, and billions of dollars in restructured debt. This is the ultimate structural trade-off of mega-asset ownership. While a small, independent commercial property owner faces a highly isolated, capped risk profile, a massive regional shopping mall operates as a highly leveraged, systemically vulnerable machine. The very scale that allows you to collect millions of dollars in net interest margins and common area fees during the boom years is the exact same mechanism that accelerates your absolute destruction when a single critical node in the network fails. The collapse of a giant like CBL proved that when trust and occupancy fail, they do so at exponential speed. To survive, the modern asset owner must entirely rewrite the rules of the game. You cannot simply surrender a $42.5 million asset to the bank. Realizing that the rigid structures of your past spreadsheets are the very things suffocating your liquidity, you must initiate a surgical restructuring of the mall's entire balance sheet. You begin by targeting the structural core of your cash flow hemorrhage, the lease agreements themselves. Instead of relying on the dangerously brittle model of high fixed base rents that drive retail tenants away during downturns, you shift towards an advanced corporate leasing strategy. You negotiate a transition to percentage rent agreements tied directly to a natural breakpoint. Under this restructured framework, tenants are granted a lower, highly sustainable base rent to protect their operational viability. But once a tenant's gross sales cross a mutually agreed-upon financial threshold, the mall takes a direct percentage of every dollar generated above that line. This aligns your incentives directly with your tenant's real-world performance, allowing you to capture massive upside during peak consumer spending seasons while offering a stabilizing cushion when market demand contracts. Next, you plug the silent operational drain of unrecovered common area maintenance fees. You systematically renegotiate your commercial lease templates to establish strict CAM recapture limits. Rather than allowing sophisticated national retailers to cap their contributions arbitrarily while you absorb the overruns, you institute a cumulative compounding cap structure. This guarantees that the mall can retroactively claw back up to 88.7% of its actual, fully loaded operational expenses once tenant sales stabilize, effectively stopping the cash flow hemorrhage that previously threatened your fund's survival. To solve the vacancy crisis left by dying legacy retail anchors, you execute a complete physical and economic transformation of the property. You understand that traditional department stores are completely defenseless against the rise of frictionless digital commerce. You subdivide the massive 85,000 square foot vacant anchor spaces, replacing them with high-margin experiential services that cannot be replicated by an online algorithm. You sign a long-term lease with a premium boutique fitness club, secure an institutional partnership to construct a state-of-the-art private medical center, and convert the remaining square footage into a premium co-working hub. These service-oriented tenants bring a massive, highly consistent daily traffic flow of affluent consumers directly to the property, completely independent of retail cycles. By reorganizing your balance sheet, stabilizing your debt service through a structured interest rate swap, and diversifying your tenant mix, you successfully preserve your investors' capital. You prove that survival in the high-stakes world of commercial real estate is not about hoping for favorable macroeconomic conditions, but about engineering structural flexibility directly into your contracts. This is just an illustrative example to help you understand the power of long-term compounding. Your actual results will depend on your income, expenses, returns, and investment choices. Whether you are managing an 850,000 square foot mega mall or simply leasing a small space for your first physical business, the structural laws of cash flow remain absolute. When you take a step back from the macro mechanics of a mega mall and look at your own financial landscape, the core lessons remain identical. Every day, small business owners and independent investors sign commercial leases for ordinary office spaces, high street coffee shops, or suburban retail storefronts, without checking the structural landmines buried in the paperwork. They fail to audit the unrecovered common area maintenance charges, and they overlook the absence of a co-tenancy protection clause. They step blindly into a system where their personal cash flow is permanently asymmetric to their fixed operating liabilities. True financial forensic intelligence is not about acquiring the largest asset on the block. It is about knowing how to inspect the foundation of any contract before you commit your hard-earned capital. You must learn to see past the glossy brochure, look directly at the hidden balance sheet traps, and safeguard your liquidity against the unforeseen shifts of the macroeconomic tide. If today's forensic financial audit has given you a completely new perspective on how big money actually flows, Hit the like button, subscribe to the channel, and leave a comment below with the next mega asset class you want us to deconstruct. We will see you in the next forensic investigation.